I hope you guys enjoyed that. I thought, it's not definitely not trading related, but I think that you saw a lot of the parallels, a lot of the things, and there was a lot of wisdom that he shared there that I think can be applied to trading. What we'll do, we'll get that in a transcript and post it on our website later today. I thought a lot of it, talking about recovering from a slump, and like you heard him say, you just got to stay focused, and sometimes, like he said, you'll throw the perfect pitch and do the perfect thing, and the ball just doesn't bounce your way. And I know everybody in here, real quick, type in yes if you've ever taken a trade setup you thought was a great setup and lost money. Type in yes. Just type in yes. I think everybody in here will probably type in yes to that. And again, it's of course it's trading, it's life. Regardless of what business you're in, sometimes the perfect thing can be in place and it doesn't go your way. So you just got to kind of persevere through it. So I thought, yeah, that's right, never. All right, well, cool. Well, I thought that would be kind of a cool thing to do to get today's event kicked off. So what I'm going to do now is turn things over to our next speaker. We are recording the whole event. It looks like we've got a great crowd, about 300 people in the room today. I'd like to thank a good friend of mine, Dan Cook of Nadex. For those of you that don't know Dan, Dan actually told me today he actually threw a no-hitter. So I said, Dan, give me something good I can kind of talk you up. You're following Jake Peavy here, a four-time Major League All-Star, Cy Young Award winner, Gold Glove winner. I said, Dan, give me something good. And Dan is actually the only person in the world that's probably thrown a no-hitter and had his team lose 5-0. So again, you guys are listening from one sports great to another. But Dan, we appreciate you guys at Nadex being so focused on trading education through the year. You've been a great partner of TradingPub, and we've had so many of our patrons start trading Nadex because of the defined risk trading that it offers. So Dan, at this time, I'll turn things over to you, and we appreciate you being here. We'll put a timer.
Thanks, Morgan. And yeah, it's a kind of a tough one to follow. Really appreciate you having Jake on. Even though, and maybe I shouldn't say this at the beginning of my presentation, but even though I am a Cubs fan, I'm really a Chicago fan at heart. And it has been 105 years since we've won anything. But yeah, I don't know if I could ever be considered a baseball great. A little bit more what Morgan was talking about was actually a game I had when I was pretty young, and probably why I never made it to any level near where Jake's made it. But basically walked a lot of runs in one day and had a lot of errors. So, sometimes those things happen. Still hasn't killed my love for baseball, but definitely not a sports great that you're listening to now. Jake made some excellent points, though, because there are a lot of correlations to sports, to trading, to a lot of things just in life in general. And one of those is being prepared and making that commitment. A lot of times we look at trading, and it's a pretty easy thing to do, right? You go, say I'm going to buy, and you place the order, and the market does what it's going to do. Very physically easy, very mentally taxing for anybody that's traded for a little while. You've got to be prepared, and it shows a good deal of commitment that you're all joining us here on a Saturday. I'm going to have a pretty light presentation, really. Again, tough to follow Jake. But a lot of things we talk about are risk, and what we focus on at Nadex is controlling that risk. I saw all the comments. We've all had those trades, that perfect setup, and all of a sudden we get slammed and it goes against us. Right? We can't control the market, what the market does. As Jake said, once that ball leaves his hand, it's out of his control, and whatever happens really is going to happen. Now, as traders, once we place that trade, we can use stops. We can manage our risk, but there could be, we've got this thing here in the States called the fiscal cliff looming. We don't know how the markets necessarily are going to move, and they can move very severely. They might not move at all. So one of the things we're going to talk about is risk, because we can only control certain things in the market, and we can't control the direction of the market even on the most perfect setup. So with that, we're going to get going here. And just real quick, we're going to talk about who Nadex is, because we are a little bit different. I recognize quite a few of the names on here, and so I know some of you are currently trading with us. And we're going to talk, one of the hot topics is the safety of customer funds, obviously over the last year in the futures industry. And then just talk real quick about the bull spread contract and how we can use that to limit our risk, how we can basically, once we place our trade, how we can at least still have total control over our downside, because it's so important. I don't know if anybody on this call has ever had a margin call, or ever lost more funds than they've had in their account, it's a very real thing. It can happen. A lot of times I kind of make a joke about it. If you've ever seen the movie Trading Places, where Mortimer has the heart attack because they got the margin call, they lost more money than they had. And in any leveraged market, Forex, futures, anytime you're basically getting more value for your dollar, to the upside and to the down, anytime you lever up your dollar, it can go against you just as easy as it can go for you. And that was one of the key things. I'm obviously biased now, but before I came to Nadex, it was one of the things that I saw, and I thought, particularly for the retail trader, for any trader really. I mean, look at all the trouble we've seen even professionals get into. So it's very important to control that risk, because there is. And real quickly, anytime we put money in the market, we can take a loss. We're probably all very familiar with that. Those losses are our responsibility. As Jake said, we have to look in the mirror and we have to reflect and we have to try to get better. And yeah, actually, Dennis, you're right on. Slippage is real, and sometimes gaps are real. Yeah, definitely ask Corzine. Ask him because he's gone through it the second time. Hopefully, there won't be a third. But yeah, with controlling risk, we can put a stop, and the currency market's 30 pips away, or maybe it's the S&P 4 points away, and the Fed can come out and say something not announced, and all of a sudden that 30 pip stop gets filled at 60, or the 4 points becomes an 8-point loss. So it's very important. Now, one thing that can't happen at Nadex, you won't see in our risk disclosure, you can't lose more money than you have in your account. Trust me, you can lose all the money you put up on a trade, but basically we're going to be talking about a limited risk contract here. And so you're never going to get a margin call. You're never going to get called upon for more funds. You basically put up your total amount of risk. And to me, that was really important. And also, as we just heard Dennis, if you saw the message there from Dennis, slippage is real. You can't get slipped at Nadex, and I'll explain why when we take a look at the contracts. So who we are, we're based in Chicago. We're registered with the CFTC. We are an exchange, so we have the same designation DCM as someone like the CME. We're also a DCO, which is a clearing organization. It just means we're self-clearing. For those of you that are in the futures market and curious about that. So we are an exchange. Our whole job is not to participate in the market, but to actually facilitate buyers and sellers, to match them up. Think of us as the auctioneer, for lack of a better term. We don't have a vested interest in the contract. We're totally unbiased, as an exchange has to be. We're just here to match buyers and sellers. All of our contracts, and the unique part of Nadex is all of our contracts are designed for the retail trader. I don't know if anybody in the meeting here has tried to trade oil or gold and have seen their margins go up quite a bit, actually, since 2008. Margins have continued to climb. It's become very expensive. Even if you're getting intraday margin, it can be pretty substantial. So a lot of times the traditional markets, which are really geared towards the institutional trader, are tough for the retail trader to get into and get involved in without taking a whole lot of either per point risk or position risk, or putting up a whole lot of margin in order to participate. So a lot of people have been kind of closed out of the markets for a long time. If they did try to get in, it was a very risky place to be. And there's risk with Nadex, but all of the contracts are much smaller. So you can trade things like S&P, Dow, gold, oil, silver, currencies, but at a lot lower, probably entry level than a lot of you have seen in the traditional markets. And we are an exchange, but we're the only exchange that accepts direct retail members. So if you open an account with Nadex, you're not a client, you're actually a member. There's no membership fee. It's just an initial deposit, but we do accept direct retail members. So there's no brokers in the middle there. And we'll talk more about that on the next slide. And Linda, I'll cover what the margins are, kind of how they work, because it's all based on risk. Real quick, sorry, I've got a little bit of a head cold here today, so once in a while you'll hear me taking a drink of water to keep my voice functioning. Safety of customer funds. We've probably all heard about MF Global. We've all heard about PFG. We've seen a couple of things that have really shaken this industry. I do believe the regulators are taking steps that will hopefully prevent these in the future, but it's really hard to regulate fraud. When you have an institution where one person or even just a couple people can have total control over all of the assets, It's very difficult to regulate in any meaningful way, although there are a couple steps that are taking which I think will be really good for the industry. And one of those, the customer segregated accounts and how those are managed and reported to the regulators is a big step in that. And so all accounts, the customer segregated accounts, which is a cornerstone of the industry, and hopefully the regulation will help make those more secure. That's how we hold customer funds. All of our funds, and I don't know if anybody's ever looked at how funds can be held. They can be held in, if you look at the document, it's about 8 pages long. There are all sorts of assets where your funds can be held. With Nadex, and we'll talk more about full collateralization in just a little bit, they're all held in cash in an account designated to you. It's a customer segregated account. The reason we have to hold them in cash is the way the exchange works, which we'll talk about in a little bit. We are subject to CFTC oversight. One of the things, being an exchange, we have to have board supervision, including 2 public board members. So we can't just have our CEO who says to accounting, hey, put this money here. We have 5 people that are involved, and 2 of those can't be affiliated with Nadex. They have to pass basically independence tests to be on the board. Also, I don't know if anybody realizes this, but when you have an FCM account, this isn't a bad thing, but a lot of brokers have what they call house accounts. They're actually taking positions in the market. They have a vested interest in what the market is doing. With Nadex, because we are an exchange, we're here to match buyers and sellers and have to be unbiased. We can't take a position in oil. We can't. I'm sorry. An FCM is basically a brokerage firm. It's a futures commission merchant. But Nadex can't take any positions in any market, because if we did, we'd be biased to our own outcomes, correct? Also, so that's one way we stay unbiased. Also, if you have a brokerage account, you can be, with your customer funds, actually subject to what they are called large trader losses. So if all of us on this meeting have $10,000 in our account, and there's this giant firm over here that has $10,000 in theirs, but they make a mistake and they lose 15, our funds can be called upon. That can't happen with Nadex because we don't have any margin calls. You can't lose more than you have in your account, so everybody's protected there. And they are fully collateralized. The question came up a minute ago about margins. We'll take a little closer look at this, but basically the full amount of your risk. I call these options for non-options traders because you don't have to spend years learning all of the Greeks. It's all basically built into the price. So there's no debit risk. You can never lose more than you have in your account, and that'll make more sense when we take a look. Unfortunately, right now, as the exchange, we cannot take IRA accounts. It's part of our regulation. Now, that being said, we will, as an exchange, one of our goals is to work with other brokers, with other FCMs, and get them connected so that you can still have that limited risk contract where you can't go upside down in your account. And as those come on board, we'll talk more about those because I think we're getting pretty close, which will be good, I think, for everybody in the industry. So one of the contracts we offered is called a bull spread. I personally hate the name. I'd rather, and you might have heard Daryl Martin from Apex before, he refers to them as a box spread because that's really what they are. We'll take a look. Yes, Jeff, as far as buyers and sellers, only those trading with the exchange are matched. We have no fungibility with the other markets, and you can never take assignment. So, for example, if you're trading oil on Nadex and your option expires, you're never going to receive assignment into an actual oil contract, and more importantly, you're never going to have to worry about taking delivery of all of a sudden 1,000 barrels of oil. So a bull spread, these are all short-term contracts. They're short-term in that in a typical contract, it can last a day or even intraday. One of the ways I look, and we'll take a look on the charts, is to use these as my entry, as an entry point because of the limited risk nature. So if I put $30 up on a contract, that's my risk. That's what I put up. That's how the collateral works, or you might refer to it as margin. It's really collateral. My total risk is my collateral. If that's $30, my risk is 30. If it's 250, my collateral is 250. And whoever is on the other side of that trade, if I'm buying, the seller is putting up the other half. So all of the contracts are fully held. It's similar if you've traded options before, and if you haven't, it's not a big deal. It's similar to a vertical call spread, only we've taken that simple strategy and made it even simpler so it looks like trading the underlying market. Every contract that we had is $1 per tick on the bull spread contracts. You can trade them long or short. So if you think the market's going to go up or down, you can basically for very low cost, if you think it's going to go down, you can trade oil. You can trade gold, up or down. Let's see here. So let's take a look at a chart, and this I think will help clear it up. I don't know about anybody else. I'm much more visual. I was a technician for a lot of years, and I have to look at a chart before I can discern anything about a contract and how it moves. But this is an oil chart, and I'm just going to highlight something here real quick. Here's the price down here. This is just the start of the chart. So oil in this day was trading right around 75. Now, if I wanted to take a position in oil, right, let's say I thought it was going to go up. Say I'm going to buy at $75. Now, margin on oil, not talking about intraday because some places do talk about intraday, initial margin on oil is something in the neighborhood of $6,800. So $6,800 in margin. What's my next step, right? I have to assess what my risk is. I have to figure out where I'm going to put my stop, right? Because I can't just leave it out there naked and hope the market goes in my favor. I've got to manage my risk. And so I'm going to put a stop in. In this case, I'm going to put a $1 stop. So if oil goes down to $74, I get stopped out. Hopefully I get stopped out. Hopefully it doesn't bounce down to 73 without hitting 74 first. On this trade, I've put up $6,800 in margin, and I've got $1,000 in risk. Now, I don't know if this has ever happened to anybody before, but the market goes along in your favor for a second, and all of a sudden it drops. Right now I'd be stopped, which is not bad because if oil continues to go down to 70, I don't want to start taking excessive losses. I tried to manage my risk. Another one that I don't know if it's ever happened to anybody, be kind of frustrating. All of a sudden, the market, maybe it dipped quick down to 73, and all of a sudden it pops back up. And what would have been a good trade, or what would have gone in your favor, who knows, maybe from here it runs up to 80 over the next couple days. It doesn't matter. You got stopped out. You're on the sidelines. Yeah, Jason, I'm with you. Happens too often. It's almost like the market sometimes has eyes. It doesn't, but it feels like that. I used to be very active in the currency markets, and I'd put on what looked like a great setup, and my risk is assessed, and I'm good, and it could almost be a little docile market, like a little lamb, and all of a sudden that lamb turns into a lion, and it spikes against me, and about the time my stop comes out, it reverses and makes a big move in my favor. Bam! I'm done. I can't sit there and cry about it, although it does hurt. And we talk about the emotional side and the psychological side of trading. Those things can be very frustrating, and particularly since, as Jake mentioned, when you're in a slump, or when they tend to come in groups. A lot of times you'll see where you place a trade, and then it's like, bam, I'm out, bam, I'm out, bam, I'm out. And so, it's a natural part of trading. We still have to manage our risk. And yeah, actually, Paul, we're going to talk about how to do this without putting a stop in, which sounds ridiculous, but when you take a look at the contract, you'll see kind of what we mean by that, because again, these are options. So we're talking about protection. So we've got the same price chart here. What we have with a bull spread is basically a floor and a ceiling. Think of it like a box on the chart. There's multiple spreads made every day. In this case, we've got a floor at 75. We've got a ceiling at 80. So the total width of this contract is $5 in oil, 75 to 80. I've got an expiration time. This is my expiration time over here on the chart. I place this trade. And what I'm going to have here is when I'm trading near a floor or ceiling, I'm going to have a little bit of what's called optionality, or a little bit of premium that I put up. So in this case, let's say oil is trading right around 75, 75.05. If I'm placing this trade, I'm actually buying this contract at 75.25. So your natural inclination might be, well, why would I do that? That's giving up 25 ticks. That's on an 8X contract, that's 25 bucks. The reason is protection. Protection from the market. We're limiting our risk. And so with options, you have premium that you put up. So right now, if I put on this trade, let's see, there we go. This is my risk. If I buy this contract at 75.25, my maximum risk is 75. That's the lowest it matters to me if the market moves. And my potential return is the remainder, 475. So there's 500 ticks here. Each cent is a tick. So if this happens, right, if the market does that again, well, we lost $25 per contract. If we were trading a per point equivalent to oil, we'd do 10 contracts. I'll explain more about that in a little bit. In this case, though, instead of putting up $6,800 and $1,000 risk and getting stopped out, we were able to do effectively the same trade, but we put up, if we did 10 contracts, we put up $250. That was the maximum risk. If the market stays down below 75 until this expires, I lost my $250. But what's neat is because these are options, this floor isn't a stop. So if this happens and the market turns and I'm right, if this happens before expiration, I've had time to be right. I can still have a profitable trade. So if this closes at, let's say 75.50, then I made 25 ticks per contract. But I didn't have to use a stop. So I got in for substantially less margin, 6,800 on the traditional versus 250 on this contract, as well as my risk, $1,000 using a $1 stop versus being able to have basically a $250 risk with no stop. Yeah, I believe this will be recorded, and Morgan will make it available. Another scenario. Let's see, ready? Will trailing stop help? Well, why even worry about the stop? And actually, what we're going to talk about, and I'll explain more about that, is when I say you can use these for entry, there's a way you can use them in combination with traditional contracts, and we'll talk more about that. No, actually, Jason, the actual, we'll walk through a couple samples here, which will kind of give you a feeling, because there's not really a lot of time priced into these contracts because they're very short term. So they kind of have to be by nature, otherwise you'd be paying a ton of premium if you were having something that went out very limited risk and you were looking out like 90 days. So if this happens, market shoots up in our favor, our maximum potential profit is up to 80. So limited risk, limited reward. But in this case, if we did this trade on 10 contracts, on one contract it's $25 risk, 475 upside. If we did 10, it's just a multiple, 250 risk, 47.50 upside. So if this happens, we had a pretty good day because that's a great risk-reward ratio. Actually, Jeff, the various contracts for the expirations depends on which one it is. So you can check nadex.com, the contract specs, because we do have intraday as well as daily, and depending on the market, the actual expiration may be different. Let's look at another scenario as well. Let's say this happens. Market went up in our favor. It expires. It expires at 77. We basically made 175 per contract. Now, the important thing here is you don't have to hold these until expiration. If a trade is going in your favor, I've always been a big fan of scaling into and scaling out of trades. So if we traded 10 contracts and, we could have set a limit order out here to sell at 76.10, maybe take a partial or the full position off. Nate, the potential profit with the 10 contracts in the previous example was $4,750 on $250 risk. Now again, that'd be a pretty big move in oil. Although, if you look at oil or any of the markets, just real quick, because we've been talking a lot this year about how kind of low volatility the markets have been, and that just shows me kind of how accustomed to volatility we've really all become. They almost don't look that exciting anymore, although they are. If you look at a chart of the S&P from 2004 and look at the move that would take place over 2 months, we can get that in a session or two now, and we consider it low volatility. Because of the events of 2008, 2009, into last August even, we see these big swings. We see gold moving $70 in a day. That's insane. A big move in gold 10 years ago, was a buck or two. And now we're looking at 17.20 as no big deal. So each contract, as far as the liquidity, Steve, on the order ticket, it'll show how many contracts are available. There are market makers, and actually every member is a market maker. I'm also in talks with a few more to try to get actually some more liquidity pumped up in these. But if you look at the order ticket, let's see, did you buy at 75.25 but buy an option to sell at 75? No, these actually, Michael, these are basically a single leg strategy. What I mean by that is you're only buying or selling, like buying or selling the underlying market. And actually, I think I'll hold that one for the next slide. Here's the next slide. So there's multiple ranges every day. So you might have a really wide start market, and then in between there'll be multiple ranges. And so when I'm buying or selling, I'm only buying or selling once. I've got a floor and a ceiling built in. So I might see, in this case, I might see a thing like Euro USD 12700 to 133, and I choose, do I want to buy or sell? We'll take a look at doing one of these close to the floor and ceiling as well. Inside of this, we have multiple ranges. And as the day progresses, because the whole point of these contracts are to limit your risk, you want to trade near a floor or ceiling, even if you give up a little bit of optionality. So here's the market. Here's the intradays at 8 a.m. Let's say at 9 a.m., the market now has moved up here. You're going to have contracts with floors and ceilings that shift along with the market. So each contract is going to be phrased as, in this case, it would be Euro USD 131 to 132, floor and ceiling. So it's very easy to determine risk reward. Let's take a look at another sample. And 1 second here, I'm going to take a little drink of water. So let's take a look at this. As far as trade management, and we're going to do a quick example of getting into a trade as well as trade management. Now, if you're a swing trader and you're on this call, you might be saying, well, geez, why would I, I'm a swing trader. I want to stay in my trade for days. Well, that's great. I think everybody actually should be a very short-term trader that's in position to let the trade run. But when we consider where all of our risk is on a trade, where is our risk? It's in the first, hour, 2 hours, maybe day. The reason for that is we're not swing traders or ever swing traders because we sit in a trade for 3 days that's going against us. There was a guy I heard years ago, and I've mentioned him a few times, Larry Pesavento, who said the only difference between him as a professional really and the guy just starting out was that he got out of his losers faster. If the market wasn't going in his favor, he didn't sit there and let him go. And it's amazing. I've seen thousands of trades, particularly when I worked at a brokerage firm. I've seen thousands of trades that people would let run against them for days, and then all of a sudden the market would pop up, and they'd be profitable for about 15 minutes and maybe a few ticks, and then they'd take their profit. It's not a good way to stick around a long time, but for some reason psychologically, we compare winning a trade or being, rather than profitability. We're like, ooh, we want to have a good trade. Well, a good trade can be one where you take your risk off right away, where you get out of it. So if you're a swing trader, you might want to look to these contracts when you're starting the trade. Because if I get into one of these with limited risk, because again, all my risk is in the first couple hours, if the market goes against me, I was wrong, but I probably had a smaller loss than I would have in the traditional contract. If it runs in my favor, simply close out the bull spread. Maybe it was that oil example we took a look at. Maybe I bought the spread at 75. It went to 77. I close out the Nadex contract. I go over to the CME. I buy an oil contract at 77 with a stop. Now, maybe it's 76. But my stop is now $1,000 in profit, trailing it, rather than up front where I took that risk. Hopefully that makes a little bit sense. So here we go. This is just an example. Let's say we're just going to go long a contract. We look for an area maybe to put a stop. Now this would be a pretty big stop on currencies. In this case, it was about 125 pips. Just zoom in here a little bit. And we've got a floor and a ceiling. So there's going to be multiple ranges every day. In this case, it's a 250 pip spread. So I'm long at 131.50. So again, where's all my risk? Let's say this is actually a combination of buying the spot FX as well as a Nadex contract. So I had my stop at 130.10. I've got the spread now. Looks like a box on the screen. We've got a ceiling and a floor and an expiration. Basically what I've done here is I've bought insurance. So I was long the underlying market at 131.35. My initial risk was basically $1,250 on this contract. Because I've got a spread that I can sell, I think to answer that was Kent's question a little bit ago, I'm now going to sell these 10 spreads. So I'm selling at 131.25, again, giving up a little bit of optionality to the market, in this case 10 pips. I'm 25 pips from my ceiling. In this case, I'm hoping I lose on the Nadex contract. The reason being, if I'm losing on the Nadex contract, I'm making money in the underlying. Here's where it becomes pretty cool, though. If I do this, this is the risk on my spread, and effectively the risk on my spread is the difference between the market and where I'm selling it. So I've got 10 pips risk. I've basically, in this case, bought insurance from 131.25 to 129.00, 225 pips, call it insurance. Now, in the underlying, instead of having my stop right up on the market, now I've basically paid my insurance premium. Now I can move my stop down basically to the floor of that spread. And so if something like this happens, okay, if I'd have just left my stop in the market, I'd have been stopped out and taken my loss. We had a pretty volatile move. Now I've been protected all the way, actually all the way down to this level, but now if this happens, I can close out my spread, move my stop behind the market, or I can just kill the trade, whichever. But instead of losing, 125 pips, I've lost 10. So it's a really good way to limit that risk. I know a lot of people used to be able to do what was called hedging, and I never liked that term. I grew up actually on a hog farm. I understand hedging exposure. When you hedge, first of all, you never want to hedge a speculative position, because if it's a true hedge, you're basically fixing your costs. That's all a hedge is. You're fixing your costs. So if you have corn and you're scared the price of corn is going to go down, well, then you take the position to offset that risk. When you're speculative, your goal, right, is to speculate, is to make money. And so why would you want to hedge it? The nice thing about these is because of the limited risk nature, and here's where I say I want to lose on this spread, well, now once the market moves past 131.50, that's where my losses on the contract stop, and the price can move as high as it wants. And so it goes boom. Oh, and actually, Tom, great point. Something I forgot to mention, algos. High-frequency trading, I'm sure, has anybody heard that term, HFT? We saw the flash crash. We've heard a lot about it. Congress is revisiting the whole thing. Obviously, have. Nadex, because we're a retail exchange, we don't sell speed. Actually, no one, we don't allow high-frequency trading. The only way anyone can even cross-connect, and that's just a term meaning connect with the exchange directly, is if they have the obligation as a market maker to make a double-sided market. They can't come in and they can't start. They can't connect directly to the exchange where you're sitting. We've got people from all over the country and world here. Maybe you're sitting in California, and by the time you're trying to get your execution onto, maybe it's a stock. By the time you're trying to get your execution, those algos and high frequencies have already, they can basically decide if it's smart money or dumb money. Because believe it or not, when you're trading with most major firms, your order never sees the light of day unless it's considered dumb money by the algos, because they've basically bought speed. They can have basically a first look. A lot of brokerage firms basically sell that right. One of the reasons commissions have come down so much is because people have sold the right basically to, instead of route your trade directly to an exchange, to send it to a high frequency shop. They can fill it, they can take the other side, or they can send it then onto the market. There's a lot of stuff happening. Nadex doesn't allow that. We don't sell speed. We won't allow high frequency trading directly into the exchange. Every member, whether they be another brokerage firm or whether they be somebody sitting in their house in Alaska, has to come in through the internet. They can't connect directly to the exchange unless they have the obligation as a market maker. It's another way we try to protect, because we're a retail exchange. We don't want retail members going up against high frequency institutional type traders. So glad you mentioned that. Thomas, because the high frequency is a big concern of mine in most markets. We do have a sim account. I'll talk a little bit more about that. Let's see. If you sold a spread, you are selling a call into put. Couldn't you then get put with more underlying? You could actually use this in conjunction with other option strategies in the other markets. There's a lot of different ways you could do this. Just to kind of keep it a little bit simpler, I just show it with the underlying market. So hopefully this made a little bit of sense on how, if the underlying market runs up here, my losses on the spread stop. So if I do a quick, another one here, this is going to be very similar. Another part to this is managing a trade. Right? We've been in those trades that they're running in our in our favor, and then we have to manage it. That alone can be a little bit stressful. It's great, but I've seen just as many people. I was a trading coach for a few years. I've seen just as many people get nervous when something's running in their favor. I had one gentleman call me up who I was coaching, and he called me up, and he had traded one contract, and it went about 125 pips in his favor, did exactly what he wanted, and then all of a sudden it dropped, and by the time he called me, the market was about 20, 30 pips against him. He's like, what do I do? And I was like, well, now it's a loss. So sometimes, we have difficulty even when the market's going in our favor on taking those profits. One of the reasons why I've heard quite a few people say it's very difficult to be a profitable trader trading one contract at a time. Because once you take it off, you're done. You're not in position to let the market run. Let's see. Jeff, to answer, no, we don't deal in high frequency at all. Not a chance. We are our own exchange, so there is no outside market to us outside of Nadex. We can't participate in any other market or engage in high frequency trading of any type. No, Jeff, we're just the exchange. We are the actual exchange. We don't have any outside affiliations. We take pricing from other markets because that's how we settle our contracts. But no, your orders, if you execute them as a member of the exchange, it's just as though if you were on the floor of the CME, not quite the same rowdy environment probably, but no, the exchange, none of your orders ever go outside of Nadex in that respect. So here's the exact same scenario basically, but here we're managing. So somebody mentioned a trailing stop earlier. So maybe we go and we had our stop at 130.10, maybe it's at 130.50, and maybe it's coming up to 130.90. And one of the difficult parts too in managing a trade is when a fundamental announcement's coming out, right? In a lot of cases, and when I was trading, I would just pull off the trade. I definitely don't want to step in front of the Fed when I've got a position that might already be 200-300 pips profitable, has been running a couple days, but all of a sudden there's a Fed decision coming out. I know that it's very possible, no matter what, if they say it could either go great in my favor or it could go against me in a massive way. And so one of the things that was always difficult was, well, geez, now I just got to take it off and we'll wait till after the announcement and see what happens. So again, same scenario. What we're doing is buying insurance. Now if we've got that fundamental announcement coming out and we're managing that trade, now we can look to offset some of our risk, again, by that insurance. And I think I'm actually running a little bit long here, so this is a very similar example again. Now if the announcement comes out, instead of losing that 1200 where we had our stop, now we basically lost 10. If it runs in our favor, fantastic. And here's how it kind of looks. If the market drops, we're protected to 12900. So we lost 10 pips instead of, if we had been moving our stop behind the market, we'd have lost 45, 85, or 125 depending on our stop. And we had time to be right. We had time to continue letting the trade work. If the market climbs, once it goes past 131.50, we stop losing money on the spread contract. I actually had a trader, I don't think he's on today, that I was talking to, who every month kept making deposits and kept losing money. And people were asking me about him. I had talked to him several times. It was actually good that he was losing money with Nadex because that meant he was making money in the other markets. I always got concerned when he had a good month with us because he was probably losing more in the underlying. His whole goal was to use us to offset his risk and to buy insurance. So he didn't mind paying us that little premium in order to buy insurance. So in this case, if the market climbs, once the ceiling's gone, we stop losing money. So in this case, out of that big run, we only lost out on 10 pips potential profit. And if the market goes unchanged, well, then we pull it off. We still leave it our underlying in, and we had a net loss of 10 pips. I'm not sure, Mark, what you mean about the spread in prices. There's some volatility price, like all options. The bid-offer spread, I think, is typically around 2 to 4 pips on the currencies. So I'm not sure if you want to clarify exactly which part of the pricing model you mean. I could probably give you a little bit better answer. One of the things, if you're doing this to hedge, Kent, what is the cost on the 10 pip ins? Well, it's your cost or your collateral that you put up. Like, for instance, let me just flip back there real quick. If I do this, basically if I sell this spread at 131.25, if I do 10 contracts, I'm putting up basically 25 pips per contract, or points technically, because it's a spread contract. I'm putting up $250 basically to buy that insurance. But again, I'm offsetting. So if I put up that 250 and the market does this, I've lost 250 here. Actually, technically no, because I've only lost the 10 in the difference between the market. So I've lost 10 pips, but once it climbs, I continue going. So my cost, or the basically the collateral to put up, is wherever my risk is. If I was selling the spread down at let's say 130-100, then my collateral that I put up is 50 pips per contract, or if I do, that'd be $50, or I could do 10 to do an equivalent for 500. Hopefully that answers the question. But if it runs in my favor, if it goes down here, it really didn't cost me anything, because I would have been losing on the underlying contract, but then I settle it up here, and it's happy days instead of having it move against me that hard. And one of the things we have to understand is the actual hedging equivalence. So again, I'm not that big a fan of the term hedging. There's just really no better way to say it. But if I'm trading one standard Euro USD in the spot contract and I want to offset some of that risk, I want to do 10 spread contracts. If I'm trading crude on NYMEX, I want to do 10 spread contracts. That makes it a per point equivalent. One E-mini S&P, 5 spread contracts would equal 1 per point. Yeah, it's basically a limited range. That's exactly what it is, James. It's a vertical call spread, and it's a really simplest form. There's a floor and a ceiling. Let's see. So when it was at 35, he bought the 25 for 10. Yeah, it's basically the difference between where the underlying market was. I definitely recommend, because this is a new concept, so I don't expect anybody. Technically, I guess it's not a new concept because we've been doing this with options for a while. Just made it a little bit simpler. Work in the demo account or the sim account. Yeah, James. Technically, it's a single leg. So if you're selling the vertical spread, it's basically like a put spread. So you'd be buying, wherever the floor is at, you'd be buying the near put, selling the further away. If you're going long, you're effectively doing the same as buying the close call, selling the call further out. Yeah, actually, we've got some, and just to let you know, I'm working this weekend to get our YouTube channel structured a bit better and a little bit more organized, because we have a ton of videos from the last even couple of years, and I'm going to be getting those up on our website hopefully next week. I know there's probably a ton of questions, but I've already gone over my time a bit here. We do have a 2-week demo. We can extend that for you, particularly if you fund a live account. I'll extend your demo out. I can do it a year at a time. So if you've got a live account, or if you come in and open up an account, Morgan might have a link where you can do that as well. I just got the beep, so I'm out of time. But if you open up, or if you have a live account and you fund it, shoot me an email, dan.cook@nadex.com. Now, I will say, after I did this last time, I think I received about 240 emails, which was pretty massive. It took me a little while to sort through. So if I don't get back to you for a day or two, it's just because I'm sorting through a bunch of them. So unfortunately, right now, the exchange can only take U.S. clients or U.S. entities. We don't have any offshore accounts. We can't accept non-U.S. entities at this time. As I mentioned earlier, we are working with a few other brokerage firms or FCMs that can connect to the exchange. There's been huge demand, really out of all over the world, Asia, Europe, Australia, for an exchange-traded product. Because a lot of these contracts are offered over the counter elsewhere, and so there's been a lot of demand. So we're really looking forward to being able to work with a brokerage firm that can accept clients from outside the U.S. But I really want to thank everybody for their time, and with that, I'll turn it back over to Morgan. Again, my email, dan.cook@nadex.com. So if you have a live account, and Morgan just put up the link there. If you open and fund a live account, I'll go ahead and extend your demo. There's no obligation to trade. We don't have any inactivity fees, and I definitely recommend everybody take as much time as they need. Like anything, it can look great, but you need to actually practice it. Particularly, these are newer contracts, and so take the time, learn it in the demo first. And actually, I already got the emails coming across, so thank you guys very much. I appreciate it, and have a great Great weekend, everyone, and very happy holidays.
All right, great. Thank you, Dan. We appreciate you being here for sure. And again, here's his email. So basically, what he was saying is, if you open an account, and if you open an account and then send him an email, he'll actually get you a demo extended for 12 months. So typically, it comes with a 2-week demo. And you can also, another link to go to. We've got a lot of really good video recordings that are posted here at tradingpub.com/nadex. That'll also email you the account link as well if you put your information in there. Basically what it does, it sends you an automated email with our recordings. I know a lot of you guys have heard of Daryl Martin, his recordings. It's got a really solid intro session from Dan on Nadex products, and then also access. We're going to do a live trading session. I know it's really good on Saturday to come in and learn, but it's even better to be able to go and see these in a live market. And so we're going to do a live trading session on Monday. So anybody that registers through that link, through this link right here, I'll type it in. It's tradingpub.com/nadex. Anybody that registers to that link will also, in addition to getting the videos, the tutorials, access to Daryl's video library as well, you'll also receive access to a live trading session on Monday to watch us trade Nadex in a live account. So that will definitely be a cool thing, and you can just register by putting your name and email and information in. And when you hit submit, it sends you an automated email to your email address with all those links that you need. So we really appreciate you guys being here. And real quick, what I'd like to do is just kind of go through a couple of quick things. There's a picture of me and my trading buddy Olivia. But I learned about the markets at the age of 16. I've traded stocks, options, futures, currencies, and Nadex. One of the things that really led me to start TradingPub.com is I've had the opportunity to learn from some excellent traders. I actually learned about trading from my father, and another guy that I've learned a lot from. You guys heard Tony Laporta last week. He's one of our commentators. I've learned a tremendous amount about the bond markets through Tony, and then another guy that if you've been around, you've probably heard of, is Larry Williams. I've actually learned a lot. I've subscribed to Larry's stuff for a while and learned a lot from him. And I'm a trader. I love trading. I love the markets, and I love learning about the markets and learning different methods. And you're going to hear from a couple of guys here that I've actually learned from as well in a little bit. Mark Sebastian, who's our next speaker, was one of our first guests we had at Trading Pub when we launched. And if you've traded options before, Mark is probably the smartest options guy I know. I know the first time I had Mark at the Trading Pub, and I consider myself to be a pretty, intermediate to advanced option trader. And the first time I was listening to Mark, I was kind of like, wait a second, I'm going to have to go back and listen to this recording again to get all this. And, just very knowledgeable. I actually had signed up for his newsletter, got that, and learned a lot. And you'll hear from Marcello later today that I've learned a lot just listening to him, and recently had signed up for his stuff. And so what I try to do is work with people that I feel really have good quality products. And because I trade on Nadex personally, I want to tell you guys about Nadex as well. And so that's one of the reasons, when you're hearing these speakers, it's people that I've listened to that I feel can really add a lot to you. So again, that's kind of what Trading Pub's all about, is learning from other traders, and we appreciate all these guys taking the time to be on and share. It was interesting having Jake Peavy on earlier. I'm a big Cubs fan. I say that unfortunately. Because as a Cubs fan, I've been conditioned for patience and accepting losses, and that's one of the things that can help with your trading. But I wanted to just share with you two quick strategies, and I'll show you these Monday in a live market. What Dan talked about, some of the spreads, he talked about binary options, but one of the most things you've got to learn, one of the most important things you've got to learn, and that now some of you guys speaking are pretty smart, so you might not have to say this, but I can comfortably say it, is that I'm not the smartest person in the world. And I'm not the smartest person in this room right now. I can say that. You take the world has billions of people. We've got 300 people in the room. I know for a fact I'm not the smartest person in the room right now. And so, you have to have a sense of humility and understand that you're going to be wrong with trading. And so at some point you've got to get out and you've got to cut your loss. what I try to do with Nadex is kind of make it simple. Is make the is I try to look at the overall market direction and say, okay, what is the overall market telling me? Is it bullish? Is it bearish? And then I look to find major points of support and resistance. So again, once I kind of determine the overall market direction, then I look for the major points of support and resistance, and I'll look for a daily binary expiration around 9 o'clock a.m. Central. So again, this is around 9 Central, and we'll show you how we do this on Monday. But about 9 o'clock Central, I'll look to buy a binary around 80 or sell a binary around 20. And so basically what I'm doing there is I'm giving myself some room, and again, we'll go more into this on Monday, but I try to give myself some room where I've got a little cushion where I can be wrong a little bit and still make money. So if I'm wrong by a little, I still make money. If the market's flat, I make money, or if it goes in my direction, I make money. So I've got kind of a 3 out of 4 scenario. The way that I lose money is if I'm dead wrong. And what I'll do there is if I see that binary that I bought for 80, if I see it trade back to 50, then I'll look to exit the trade. If I see that binary that I sold at 20 or 30, if I see it trade at 50, then I'll look to exit the trade. So by doing that, I'm able to somewhat keep my risk reward at a 1-to-1 ratio. So again, what we'll look at a couple different markets to trade. Yeah, if you've got NinjaTrader, you can definitely use Ninja charting. And CD, we'll do the live Nadex trading 8:30 on Monday morning. If you go to this link, all you do is you go to tradingpub.com/Nadex. All right, you put your name and your email in. It'll shoot you a copy of the invitation. In addition to that, video tutorials, training, and just some general awesome Nadex stuff. You'll get access to our Nadex library, to Daryl Martin's Nadex library, and lots of good videos and recordings. So we appreciate you being here. Dan, I thought you did a great job. You know, you had a tough act to follow, following Jake Peavy, but again, you did an outstanding job. I think everybody in here enjoyed it. It seemed like there was lots of questions. And remember, you know, if you send Dan an email, dan.cook@nadex.com, if you've got a live Nadex account, he'll get you set up with an extended demo for 12 months. So again, we appreciate you guys being here. At this time, I'm going to turn it over to our next guest, is Mark Sebastian, and Mark's going to talk about building a trading plan. Mark, we appreciate you being here today. And real quick, Mark, if you can come on to a quick audio test, and then we'll turn things over to you.